welcome to the deep dive. Let's tackle something that really changes gear when you retire. Managing taxes.
Yeah, it's definitely not like the working years, is it? No more simple paycheck withholding for many.
Exactly. Suddenly you've got income maybe from pensions, IRAs, Social Security investments, all sorts of places.
And the taxes might not be taken out automatically,
Hmm.
or maybe not enough is taken out. That's a common headache.
Right. So today's deep dive, we're focusing squarely on understanding your federal tax situation in retirement.
We're using some great info from Charles Schwab as our guide here. The goal is really clarity, some actionable tips.
Yeah, trying to help folks avoid those nasty surprises come tax day.
Absolutely. And Schwab breaks it down nicely with 4 key questions. We'll use those as our roadmap.
Okay.
First, what are your retirement income sources? Where is the money coming from?
Makes sense.
Second, how much tax is actually being withheld from those sources, if any?
Okay.
Third, how do you figure out what you actually owe, like the total amount?
The big number. Got it.
And fourth, what's your plan to pay it? How do you actually get the money to the IRS?
Perfect. So by the end of this, hopefully, everyone listening will feel a bit more confident about their retirement taxes.
That's the plan. Give you a clearer picture, some strategies.
All right, let's dive in. Question 1. What are your sources of retirement income?
Okay, this is fundamental. The IRS generally puts your retirement income into 2 main buckets for tax purposes.
The 2 buckets.
Yep. Ordinary income and long-term capital gains. They're taxed differently.
Okay, let's start with ordinary income. What falls under that? Sounds like, well, regular income.
Pretty much. Think of it as your sort of day-to-day income. It gets taxed at the standard federal rates, currently 10% up to 37%, depending on your total taxable income.
And what kind of retirement money is in this bucket?
Quite a lot, actually. Any wages, if you're still working part-time, maybe. Interest from savings, CDs, most bonds.
But not municipal bonds, right? Those are usually tax-free.
Exactly. Good point. Tax-free muni bonds are the exception there. Also, ordinary dividends from stocks or funds.
Fair.
And short-term capital gains. That's profit from selling something you held for a year or less.
Got it. Short-term means ordinary rates.
Correct. And critically for retirees, taxable withdrawals from your traditional retirement accounts, your 401k, your traditional IRAs.
Ah, the pre-tax money. Now it's time to pay the piper, so to speak.
That's the idea. Since you got a tax break putting it in, you pay ordinary income tax when you take it out.
Makes sense. What else counts as ordinary income?
Well, taxable Social Security benefits. And remember, up to 85% of your benefits can be taxable.
85%. That's often a surprise for people.
It really can be. Depends on your total combined income. Also, non-qualified withdrawals from HSAs before you hit 65.
Okay.
And the taxable parts of annuity payments and pension payouts, how much is taxed there, often depends on whether you use pre-tax or post-tax money originally.
Right. The contribution type matters.
Definitely. And finally, if you're a landlord, rental income is ordinary income too.
Wow. Okay. That's a pretty broad category. So what's the other bucket? Long-term capital gains.
Right. This is where you might get a bit of a tax buck. Long-term capital gains are profits from selling assets you've owned for more than a year.
Longer than a year. And the rates are better.
Generally, yes. The federal rates are 0%, 15%, or 20%. Again, depends on your overall taxable income, but usually lower than ordinary income rates.
0%. Some people pay nothing.
Yeah, if your taxable income is below a certain threshold, your long-term capital gains could actually be taxed at 0%. It's a significant potential benefit.
Okay, so what kind of assets usually fall into this? Things you hold on to.
Exactly, like selling a business you owned for years. Or real estate.
Like your house.
Could be. And there's that big potential exclusion for your main home, right? Up to $250K gain excluded if single, $500 if married, if you meet the ownership and use tests.
Right. 2 out of the last 5 years. That's a huge benefit for homeowners.
It really is. Also, stocks, bonds, mutual funds held over a year. Most other assets, too.
Okay. And dividends. You mentioned ordinary dividends before.
Good catch. Qualified dividends fall into this long-term capital gains category, too. They get the lower rates.
So, important to know if your dividends are ordinary or qualified.
Absolutely. It makes a difference to your tax bill. So, holding assets longer than a year can definitely ease the tax bite.
Clear takeaway there. Now, you also mentioned something, the Schwab piece highlighted it, the net investment income tax, NIT.
Yes, the NIT. This is a heads up, particularly for retirees with higher incomes. It's an additional tax.
On top of the regular income tax or capital gains tax?
Exactly. It's an extra 3.8% tax specifically on certain types of investment income.
Like what?
Things like interest, Dividends, both ordinary and qualified capital gains, rental and royalty income,
Yeah.
income from non-qualified annuities, basically most passive investment income.
Okay, 3.8% extra. Does everyone pay it?
No, there are income thresholds. It kicks in if your modified adjusted gross income, or NAGI, is over $200,000 for single filers or $250,000 for married filing jointly.
MGI.
Mm-hmm.
So not just your regular AGI.
Right, modified adjusted gross income. It's slightly different. But the point is, if your income's above those levels, this extra 3.8% tax applies to your investment income. Something to definitely factor in.
That's a really crucial detail for higher earners. Okay, so we've got a handle on the types of income. That leads us right into question 2. How much are you withholding?
And this is where it gets maybe a little tricky in retirement, because withholding isn't consistent.
Not like getting that regular paycheck stub showing deductions.
Exactly. Some income sources have automatic withholding, some don't. And even when they do, like we said, the amount might be way too low for your actual total tax bill.
Okay, let's break it down by source then. What about typical workplace retirement accounts, like 401k or 403bs?
Generally, if you take a regular withdrawal, not like a series of payments, the default federal withholding is 20%. Mandatory, usually.
20%, okay.
But, and this is important, for required minimum distributions, RMDs, which start at age 73 now,
Right.
the default withholding is often only 10%.
Only 10%. That seems low if you're in a higher bracket.
It very often is. The Schwab piece gives a good example. Someone 73, maybe a $2.5 million IRA, their RMD could easily push them into the 22% bracket or higher. That 10% won't cut it.
So you'd owe a lot more come April?
You could, yeah.
Yeah.
Big surprise, potentially. So you might need to tell them to withhold more.
Can you do that? Change the withholding.
Yes. For these non-periodic withdrawals, like a lump sum or an RMD from a 401k, you can use IRS Form W4R. You give that to your plan administrator to specify a different withholding amount or percentage.
Okay, W4R for 401ks and similar plans. Good to know. What about annuities and pensions, those regular payments?
For taxable periodic payments from pensions and annuities, the withholding is typically based on the IRS withholding tables, like wages used to be. It uses publication 15T.
So it's more like paycheck withholding.
Sort of, yeah. It depends on what you put on your withholding form for that income stream, and if you want to adjust that withholding.
Is it the same form, W4R?
No. For pensions and annuities, it's typically IRS Form W4P. You submit that to the payer, the insurance company, or pension plan.
Okay, W4P for pensions and annuities. Different forms, got it. How about Social Security? You said up to 85% can be taxed. Do they withhold automatically?
Nope. That's another big one. No automatic federal withholding on Social Security unless you specifically ask for it.
Really? So you have to opt into withholding?
You do. You need to fill out Form W4V, V for voluntary, and send it to the Social Security Administration.
Okay, W4V to SSA, and can you choose how much?
They offer fixed percentage options, 7%, 10%, 12%, or 22%. You just check the box for the rate you want withheld from your benefits.
So you've got some control, but only those specific rates.
Correct. Given how much might be taxable, it's really something people should look at proactively.
Definitely sounds like it. Okay, what about regular taxable accounts? Brokerage accounts, bank accounts, dividends, interest, capital gains.
Yeah. Generally speaking, there's no automatic federal tax withholding on that stuff. When you sell stock for a gain or get a dividend payment, the brokerage usually doesn't withhold taxes.
So if a lot of your retirement income comes from investments,
Then you've got to cover those taxes somehow, either by withholding more from another source, like your IRA withdrawal or pension,
right?
or you'll likely need to make quarterly estimated tax payments yourself. We'll get to those in a bit.
Okay, so no free ride on investment income withholding. What about IRAs? Traditional SEP, simple IRAs.
Similar to 401ks for non-periodic withdrawals, the default withholding is usually just 10% unless you tell the IRA custodian otherwise.
Just 10% again. Seems low.
Often is. And again, if you want to change that for non-regular withdrawals, you use IRS Form W4R, just like with the 401k.
W4R again for IRAs.
Mm-hmm.
Okay. So the big picture on withholding is be proactive. Check each source.
That's exactly it. Know the rules for each income stream, see what is being withheld, and then figure out if that's actually going to be enough to cover your total estimated tax bill for the year.
And the source mentioned periodic versus non-periodic payments affecting withholding rules sometimes.
Yeah, the IRS does draw that distinction, particularly for pensions and annuities. Periodic or regularly scheduled payments Non-periodic are more like one-off withdrawals. The withholding rules can differ slightly.
So if you're unsure,
Check the IRS guidelines, publication 15T maybe, or definitely talk to a tax pro. They can clarify how your specific payments are treated.
good advice. Okay, so we know where income comes from. We know about withholding, which naturally leads to question 3. What do you actually owe? The total tax bill.
Right. And the article acknowledges this can feel, a bit intimidating, especially that first-year retirement. There isn't some simple IRS retirement tax calculator.
Yeah, it's not like just plugging numbers into TurboTax easily when your income sources are all different.
Exactly. It's a shift. Multiple income types, maybe new deductions or credits you weren't eligible for before. It can seem complex.
But there are ways to get an estimate, right? The article mentions some tools.
Yes, absolutely. It points out there are helpful online resources that can give you a starting point, a ballpark figure.
Like what?
Well, AARP has a tax calculator, and most of the big tax software companies, H&R Block, TurboTax, they offer free online estimators too.
So those can give you a rough idea.
Yeah, you plug in your estimated income, filing status, potential deductions, and they'll spit out an estimate. But remember, it is just an estimate.
Not the final official number.
Definitely not, but a good starting point to see if you're likely to owe money.
So if those are just estimates, what's the recommended way to get a more accurate figure, especially early in retirement?
The strong recommendation, and I think it's really sound advice, is to work with a tax professional, especially in those first few years.
A CPA or an enrolled agent.
Exactly. Someone who understands the nuances of retirement income, RMDs, Social Security, taxation, potential deductions. They can calculate your liability accurately.
Or probably more than just calculation,
Yeah.
right?
Oh, absolutely. That's maybe the bigger benefit. They can look at your whole picture and suggest strategies, maybe ways to structure withdrawals, to minimize taxes, or plan for future tax efficiency. It's about strategy, not just compliance.
That sounds like money well spent, potentially saving you more in taxes than their fee costs.
It often is, especially when things are changing as much as they do when you first retire.
Okay, smart move to get professional help. So let's say you have a decent estimate of what you owe. That brings us to the final question. What's your payment plan? How do you get that money to the IRS?
Right. Basically, two main paths here.
Okay, what's path number 1?
Adjusting your withholding from the sources that allow it. We touched on this.
Right, like telling your IRA custodian or pension provider to take out more tax.
Exactly. The article suggests this might be the easiest way for many people. Kind of a set it and forget it approach once you figure out the right amount.
How would that work, practically?
Well, say you estimate you'll owe $30,000 in federal taxes for the year, and you plan to take $100,000 in withdrawals from your 401k. Okay. You could just tell your 401k provider to withhold 30%, $100,000 from every withdrawal.
And that should cover it, assuming your estimate is good and that's your main income.
Pretty much. The article also makes a good point. If you do this, make sure you adjust withholding on other sources down to 0, probably. You don't want to accidentally over-withhold.
Good tip. Avoid giving the IRS an interest-free loan.
Precisely. The big plus here is simplicity. You're not tracking quarterly deadlines. It just happens automatically with your withdrawals.
Seems like a solid option if you can make it work with your income sources. What's the other main path?
Making quarterly estimated tax payments yourself directly to the IRS.
Okay, who needs to do this?
This usually comes into play if you have significant income from sources that don't have withholding. Like we discussed, maybe big capital gains from investments, rental income, self-employment income.
Or if the withholding from your other sources just isn't enough to cover the total.
Exactly. If you calculate you'll still owe taxes after all your withholding, you generally need to make up the difference with estimated payments.
And there are deadlines for these, right? Throughout the year.
Yes, 4 times a year, usually April, June, September, and then January of the next year for the last quarter.
And what happens if you're supposed to pay estimated taxes, but you don't? Or you pay too little?
You can get hit with an underpayment penalty from the IRS, plus interest. So it's important to get it reasonably right.
Which sounds like another reason to maybe get professional help, at least initially.
Definitely. Calculating the right amount for each quarter can be tricky, especially if your income isn't steady. A pro can help you figure that out. The form for this is Form 1040-ES, Estimated Tax for Individuals.
Okay, 1040-ES. So 2 main routes. Adjust withholding or pay quarterly estimates. Choose the one or maybe a combination that fits your situation.
That's the idea. Plan how you're going to pay.
Now, the article ended on a positive note. Some very good news for simplifying things after that first, maybe complicated retirement year.
Yes. This is a really useful safe harbor rule from the IRS. It helps you avoid underpayment penalties in subsequent years without having to precisely estimate your tax liability each time.
Okay, how does that work? A shortcut.
Kind of. Basically, you can avoid penalties if you make sure your total withholding and estimated payments for the current year equal at least 100% of the total tax shown on your previous year's tax return.
So just pay the same total tax as last year.
Yes, if your adjusted gross income, AGI, in that previous year was $150,000 or less.
Great. 100% of last year's tax if AGI was 150K or less? What if it was higher?
If your prior year AGI was over $150,000 or $75,000 if married filing separately, then you need to pay in at least 110% of the prior year's tax liability to meet the safe harbor.
110% for higher incomes. Got it.
So you figure out last year's total tax, apply the 100% or 110% rule based on AGI, and make sure your withholding and payments for this year add up to that amount.
And if you do that, you're generally safe from underpayment penalties, even if your actual tax liability for the current year turns out to be higher.
Exactly. It's a way to simplify things immensely after year one. You might still owe a little bit more come tax time, or you might get a small refund if your actual tax is lower, but you avoid the stress of penalties and complex recalculation.
That does sound like a huge weight off the mind. Focus on hitting that prior year number.
It's all about simplifying and reducing worry. A very practical tip.
Definitely. Okay, so wrapping this all up, we've covered a lot of ground on managing retirement taxes. What's the core message people should take away?
I think the main thing is that it is manageable, even if it seems complex at first. It really boils down to understanding those 4 questions.
Your income sources.
Right. Then, how much is being withheld?
What you think you'll owe.
And how you plan to pay it. If you break it down like that, asking those questions about your own situation, you can get control over it.
And we kept coming back to the value of professional advice, didn't we? Especially early on.
Absolutely. Don't hesitate to get help. A good tax advisor pays for themselves, often not just in accurate calculations, but in finding strategies, giving peace of mind. They know the rules, the forms, the potential pitfalls.
So maybe a final thought for everyone listening. Really take a look at your own situation now. Do you know where all your retirement income is coming from?
Yeah, and do you know how much tax, if any, is being taken out? Is it likely enough?
Should you be thinking about adjusting withholding somewhere? Or maybe setting up those quarterly estimated payments?
Don't wait until next March or April to figure this out. Being proactive now can save a lot of scrambling and potential stress later. Take control of your retirement tax picture.
Excellent advice. Thanks for walking us through that.
My pleasure. It's an important topic.
Thanks for taking this deep dive with us.